we always said that we're going to look at all instruments, and President Lagarde has also made that clear in the press conference. But of course, I mean, there are reasons why we haven't reduced interest rates in the past, and now we have to check whether these reasons are still valid.
Which are the reasons for not dragging them lower? And perhaps that might also make the market understand what are you looking at exactly?
Well, I mean, one important argument is, of course, which effects low rates may have on the banking sector. I mean, we have been thinking about this quite a lot. Of course, we've also introduced new measures which help to counteract these effects, the tiering multiplier, which is quite important, and I think this has been quite successful. But all of our monetary policy decisions are always cost-benefit analysis, and so we have to look at the effectiveness of the measures in the current circumstances, and we have to think about the side effects, and we will always choose those instruments for which this balance is the best.
President Lagarde has narrowed down the focus on PEP increases and also potential new TLTROs or a recalibration of the current TLTROs. So how likely do you think we will get also an extension of the whole program? Because clearly that would also be a big signal.
Yes, so I mean, what the Governing Council said is that in the December meeting we are going to recalibrate our instruments as appropriate in order to preserve the favorable financial conditions and in order to counter the impact of the pandemic on our inflation outlook. And what the President added in her Sintra speech is that she said, and I think that's an important point, that it's not just about the level of financial conditions, but it's also about the duration. So I think the important message is that the ECB is going to be there as long as is necessary. And what that means, of course, depends very much on the evolution of the pandemic. It depends on the speed of the rollout of the vaccine. All this, of course, is very important. And I think, given that all these measures may be with us for quite some time, and that we also know that potential side effects may get bigger over time, I think we also have to discuss the intensity of our asset purchases, which is also important. So we have to ask what is the intensity of purchases that is needed to preserve these historically low financial conditions.
Do you mean by intensity the pace of purchases per month?
Exactly.
So would you rather say we need to be very flexible when it comes to that? So you, for example, if you see fragmentation coming up, if you see the economy deteriorating, that you can increase it very flexibly?
Yeah, the flexibility is certainly key. I mean, we have seen that in March. The flexibility was extremely important to deal with that situation of market turbulence. Of course, we are now in a very different situation than in March because financial conditions are extremely benign and we do not face a market disturbance. And this is also why I think we cannot just do the same all over again, but we have to rethink what is the best and most efficient way to do it in order to achieve our objectives. There is broad agreement that what is key is that financial conditions remain at this favorable level. And the question is how this can be ensured best. And let me add that monetary policy will not be able to do it alone. We also rely on fiscal policy, which has to remain active as long as needed. So monetary and fiscal policy have acted in a very complementary way in the past month, and I think this should continue. So both monetary policy and fiscal policy have to make sure that they are not withdrawn too early. And especially at this current time of very high uncertainty, the fiscal side is important because the private actors may actually be reluctant to spend. Consumers may be reluctant to consume. firms may be reluctant to invest, and this is why then the public expenditure is very important, which may then also spill over to the private spending part.